Hey everyone, it's Tony Leonardi, your certified financial planner professional from Newtown, Connecticut, back with another episode of A Smarter Way to Retire. Because there really is a smarter way to retire. Today we're talking about something that keeps more families up at night than almost anything else: generational wealth transfer, and how to protect your legacy from unexpected tax traps. There's a $7 trillion great wealth transfer happening right now as boomers pass on assets to their kids and grandkids. But without the right plan, a big chunk of that could end up in the pocket of the IRS instead of your family's pocket where it belongs. By the end of this episode, you'll know the hidden traps, the proactive shields, and the real world mistakes to avoid. So let's dive in. Picture this: you worked hard for 40 years, you planned well, you invested intelligently, you built a nice nest egg, lived a great life, and now you're starting to think about passing it on to your family. You think, oh, this is pretty simple. Whatever I have left, my kids will get it tax-free, right? No, that's wrong. The silent tax erosion is a ticking time bomb for most plans. Many families lose 20 to 40% of their legacy to taxes that they never saw coming. Not just federal estate tax, but state inheritance taxes, capital gains taxes on appreciated assets, income taxes on retirement accounts, and gift tax gotchas. Common misconception number one: everything's tax-free under the exemption amount. Well, the federal estate tax exemption right now is $15 million per person in 2026, thanks to the one big beautiful bill that locked that in last year. But state inheritance taxes kick in often at much lower levels. If you live in Connecticut like I do, Connecticut matches the $15 million federal exemption. But if you live right up the street in Massachusetts, the exemption is only $2 million. In Rhode Island, $1.84 million. And if you live in Oregon, it's only $1 million. So you have to be very careful based on your state of residence in terms of state inheritance taxes. Now that's the exemption. Tax rates above the exemption go as high as 35% in Washington state, with many states in the 16 to 20% range. That will add up fast if you don't plan well. Now, federal estate taxes hit especially hard for business owners who have built successful businesses and want them to survive for the following generations. Imagine owning a business, and the IRS says it's worth $50 million when you die. That business has to come up with $10 million in cash to pay Uncle Sam. Many small family-owned businesses don't survive for the next generation because they haven't adequately planned for the estate tax bill. We do a lot of work with business owners, helping them to reduce or even eliminate estate taxes so their businesses survive after they're gone. If you're a business owner and you're not 100% sure that you've exhausted all of your options in this area, let me know. You don't want to leave options on the table, that's for sure. Misconception number two: gifts are always free. Okay, gifts are tax-free, but only up to the annual exclusion amount, which this year is $19,000 per person, which means you can give up to $19,000 per person per year to as many people as you want. But lifetime gifts over the exemption could trigger a 40% tax, and informal loans often get reclassified as gifts during audits, and they can trigger penalties. Gifting is a great way to reduce your taxable estate. It's one of the most underutilized estate tax reduction techniques. Why? Because people are afraid to give away money if they think they might need it down the road. Do you know how to address this problem? You need a good financial model to help you make smart decisions. If you don't have a good financial model, let me know. So what's going on in DC with recent legislation and discussions around estate taxes? Well, the bill last year made the exemption permanent, but in Washington, permanent doesn't have the same meaning as it does out here in the real world. DC is still talking about potential tweaks like lowering exemptions or changes to trust rules. There are even talks about getting rid of the step up in basis rules. So nothing's set in stone, but in 2026, with midterm elections right around the corner, things could change pretty quickly. So we'll always keep an eye on what's going on in Washington, D.C. that can affect your plan, and we'll keep you up to date. The bottom line, if you don't plan properly, your legacy could shrink quietly, and your heirs will pay the price. So let's pull back the curtain on the 4 biggest tax traps that I see. Beyond the federal estate tax exemption, states add their own inheritance tax. Connecticut has an estate tax starting at $15 million, mirroring the federal exemption. But if you own property in another state or you live in another state, you could trigger taxes there as well at that state's lower exemption amount. If you own a condo in Florida, for example, no tax on the condo in Florida, but Connecticut will tax that Florida condo as part of your total net worth. How about gift taxes? The annual exclusion lets you give $19,000 per person tax-free, but exceed the lifetime exemption and it's a 40% tax. Informal gifts like paying a grandkid's tuition directly to the college, perfectly fine. But undocumented loans to kids for a house down payment, or giving your business or land to your kids, the IRS will call these gifts during an audit and apply penalties. How about capital gains on inherited assets? This is the often missed trap that catches even savvy families off guard. Appreciated real estate, stocks, or other investments passed down to your kids. Let's say you bought a family home for $100,000 decades ago, and it's now worth $1 million. If you leave it to your heirs at death, they get a step up in basis to $1 million. So if they sell it, zero capital gains on the $900,000 of appreciation. The trap? If you gift the asset during your life, your heirs get your original $100,000 basis. They sell for $1 million, they pay capital gains on the full $900,000 gain at 15 to 20% rates plus state tax, potentially costing $135,000 to $180,000 in unnecessary taxes. The same goes for appreciated stocks. Your $50,000 investment in Apple decades ago, now worth $500,000. Heirs pay tax on the $450,000 gain if gifted to them during your lifetime, but zero if inherited at death. With real estate making up 60 to 70% of many families' estates, this trap can wipe out hundreds of thousands of dollars if you gift too early. Do you know anyone who has said, "Oh, I just put my kids' names on my accounts so they'll get them when I'm gone"? Or, "I gave my kids my house to avoid probate"? You just fell into the capital gains tax trap, and Uncle Sam thanks you. How about income tax on IRAs and the 10-year rule? This is another big one. Inherited traditional IRAs are fully taxable as ordinary income to heirs. No step up in basis on retirement accounts. Non-spouse heirs, meaning your kids, must empty the entire account within 10 years, often in their highest earning years and in high tax brackets, 32, 37% plus state income tax. A $500,000 IRA left to your kids could cost them $150,000 to $200,000 in taxes. Roth IRAs avoid this, but conversions trigger tax for you now. The question is, who should pay the tax, you or your kids? We'll help you run those numbers if you want some help. These tax traps turn tax-free inheritance into a tax bill that your heirs weren't expecting. The good news, you can shield your legacy with 3 proven tax moves. Number 1, strategic gifting. Use trusts like ILITs, Irrevocable Life Insurance Trust, or GRATs, Grantor Retained Annuity Trusts, for tax-efficient distribution. Give $19,000 per year per person now, or Super Fund 529s for grandkids. You can put $95,000 in up front, which equals 5 years of gifting all at once. If you're a business owner, there are lots of different options to use leverage and discounts to gift more efficiently. Structured right, these can reduce your taxable estate, reducing or even eliminating what goes to the IRS. Stepped up basis magic. Hold appreciated assets like stock or real estate until death. Heirs get the current value at their basis. Leaving $1 million house to your kids that you bought for $100,000, zero capital gains for your heirs. This is the rule that saves families a fortune, but only if you don't gift too early. Number 3, insurance solutions. Use permanent life insurance or annuities as tax advantage tools. Fund these with RMDs that you don't need. The death benefit is 100% tax-free, no 10-year rule, no required minimum distributions, no forced distributions, potential for multi-generational wealth that is creditor protected here in Connecticut and in many other states as well. I have one client that turned $90,000 in RMDs that they didn't need into $2.9 million tax-free for their kids and grandkids for multiple generations. Super powerful. These tax shields turn tax traps into opportunities. So what are your next steps to secure your legacy? You should have your essential documents: wills, trust, powers of attorney. If you don't have them or they haven't been updated in the last 3 to 5 years, update them by the end of 2026. Find your team. You should have a financial advisor, an estate attorney, a tax specialist, all on the same team. Your financial advisor ideally should be your quarterback, guiding the team. If your advisor isn't proactively taking this quarterback role, coordinating your plan, let me know. Here's your call to action. Have your entire plan reviewed today. Top to bottom, your legacy and your family depends on it. There are 2 easy ways to get started. You can take my free 2-minute retirement readiness quiz. You'll get a score instantly and a complimentary copy of my book, A Smarter Way to Retire. You can find it on my website, leonardifamilywealthcare.com/quiz. Or you can book a complimentary 15-minute call with me. I'll review your legacy plan with your real numbers and let you know if you're in danger of stepping into any of these tax traps. You can find my calendar on my website, leonardifamilywealthcare.com. Look for my contact and Calendly tabs. Thanks for listening. Don't forget to plan smarter, retire happy, because there is a smarter way to retire. We'll see you next week.
Securities and investment advisory services offered through Mosaic Wealth, Inc., member FINRA SIPC. Mosaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Mosaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Mosaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.